Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Are you ready for some straight talk on retirement planning without all the fluff? Well, you found the right podcast. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. Thanks for joining me today. On this week's episode, we're going to talk about year-end tax planning. When this episode launches, it'll be mid to late December 2024. Like I said, my name's Greg Gonzalez. I own a retirement planning firm, and tax planning is a lot of what we do. And a lot of these strategic tax decisions that you make can be done at the end of the year, where you can really pinpoint exactly how much it takes to kind of move the needle in your favor. So today's episode is really going to focus on those year-end tax planning ideas that you should kind of consider and see if they apply to you. I'll even mention a book during this podcast that I think is phenomenal, especially for anybody who owns real estate or those that own businesses. This is a phenomenal book that I highly recommend that you check out. So we'll talk about that, or I'll try to remember that later on in today's episode. And just a reminder, if you're a new listener or maybe a reoccurring listener and just haven't checked out our website, retirementmadeeasypodcast.com, there I'd like everybody to submit their questions as we're developing new episodes for 2025. We will use your listener questions and you can submit them for free. You can even make it anonymous, make up some name or something. retirementmadeeasypodcast.com. A lot of people have enjoyed the podcast. A lot of people have reached out to us when they're at the phase in life where they're interviewing a retirement planner. And there's a forum on our website where you can fill out and we can see if we're the right fit for you. There's a lot of great retirement planners out there, but not all of them do a podcast. So again, check out our website, retirementmadeeasypodcast.com. We'd love to hear your questions. So on this week's episode, like I mentioned, we wanted to talk about year-end tax planning. When I say year-end tax planning, a lot of people think of two things immediately. They think of, okay, are there any investments that you can sell and you can harvest a loss, which you can therefore deduct on your taxes? That's called a capital loss. And if you own that investment, and again, this is not in a retirement account. This would be in a brokerage type account or a trust account, some type of non-retirement account that you have a stock, a ETF, a mutual fund, index fund, something like that. If you happen to have a loss, you can sell that security at a loss, and you can then deduct up to $3,000 a year on your taxes. Let's assume you have a security and you have a $6,000 loss and you sell it in December at the end of the year. And you say, well, gosh, what happens to the other $3,000 of losses? Since I can only deduct $3,000 on my 2024 taxes. Well, you get to carry over any losses over and above $3,000. Now, in a year like this, 2024, when the market has done extremely well, this is a year that you might not have a lot of losses, or hopefully you don't have a lot of losses to deduct, but it's something that you need to at least look at and say, okay, is this an opportunity or not? Would it make sense to sell something, a security, an investment at a loss, book the loss, and they allow you, again, $3,000 per year as a capital loss. So that's something that we're looking at, like with our team here at my firm. We're looking at short-term capital losses. Are there any long-term capital losses? Do we want to harvest gains to offset the losses? So this is kind of the capital gain, capital losses discussion or decision that a lot of people have at the end of the year, where they want to either harvest gains or harvest losses. And the other thing that I have been a big proponent of is, for most people, Roth conversions at the end of the year in December. We do more Roth conversions in December than any other month of the year, especially for some people that have variable income. And what I mean by this is it's hard to gauge what is going to be the sweet spot for a Roth conversion when their income is so unpredictable or variable. And for those people, it makes much more sense, in my opinion. If you don't know what your income's going to be at the end of the year, hold off on a Roth conversion until you can really, really nail that down and you have a tally of all the income that you have for the year. And then you can do your Roth conversion before year end and have a very, very strategic Roth conversion amount. Let me give you a really, really elementary example of this. Let's say somebody's income is variable and they get bonuses quarterly. So they don't know if those bonuses are going to be $1,000 or $20,000. Somebody that's in business development or sales might fall into this category or might not, depending on how much of your income is salary versus maybe a bonus or commission or something like that. So for somebody like that, it just makes so much sense to wait until the end of the year to really say, okay, how much money have we made this year? And before year end, maybe it's a $20,000 Roth conversion that bumps you up to the top of your tax bracket. That's what makes most sense. But figuring out what is that gap, what is that sweet spot that's going to take you up to the ceiling of your current tax bracket, that's where strategic decisions come in. Now, for somebody that has a very, very steady paycheck, is not compensated with bonuses or commissions or any of that kind of stuff, I have a client that says, hey, I'm not getting any raise for this next year. My paycheck, I get paid every 2 weeks. It's the same amount. Well, that person's going to be a piece of cake as far as calculating an optimal Roth conversion. And you really don't have to wait until the end of the year to do the Roth conversion because your income is so predictable. But we've got a few clients, for example, they get bonuses around November, December 1st, and we don't know, it's kind of unpredictable what that amount's going to be. But whenever we know and we get that news, okay, now we can update our tax report really, really quickly. And we know, okay, is it going to make sense to do a Roth conversion this year? And if so, how much? It's been a couple of years ago that we had a new client that looked us up I think they hired us around October or November, and they were debt-free. They lived a very modest lifestyle. And looking at their income, they were living on their Social Security and a small pension. They lived well within their means. They were in a very low tax environment. And doing our little tax analysis, the first thing that I considered was, gosh, you two are going to be able to do a Roth conversion and pay zero taxes. You realize that, don't you? And I remember the wife looked at me and said, how is that possible? How can we move money from our IRA into our Roth IRAs and pay zero taxes? And we went through the tax report together, and I said, this is where you stand. You see that green dot, and you've got about almost $11,000 that you can do as far as a Roth conversion before the end of the year and pay zero income taxes. And she looked at her husband and said, we retired 3 years ago. He's telling us we can do this now. What about the last 3 years that we missed out on? And unfortunately, you can't go back on Roth conversions. So you have until the end of the year to get these Roth conversions done. You cannot go back and modify or amend your taxes and tell the IRS, oh, hey, I meant to do a Roth conversion back in 2022. Unfortunately, that's not how it works. That's not how amendments to tax returns work. So we've gone over capital losses. So check to see if there's any capital loss, capital gains harvesting that makes sense for you. Roth conversions. And in a lot of people's instances, it makes sense, especially when you have variable income or unpredictable total household income, to wait until the end of the year when you can put your finger on what your total taxable income for the year is going to be. And I'll give you a perfect example. Let's say you do your Roth conversion in January and you make a lot of money or you have a huge bonus. And instead of being in the 24% bracket, you now do this Roth conversion, get these big bonuses and this large income, and now you're in the 32% bracket. And you only intended to really top out the 24% bracket by doing that Roth conversion. And believe me, I've seen this. It's like giving Uncle Sam an 8% tip, and we don't recommend that. The other thing, as far as year-end tax planning that we always talk about, is charitable giving. We look at, okay, what is your total year-to-date amount of charitable giving, and where has that come from? Were you giving stock or appreciated assets, or was it cash, or a mix of the two? Were you 70 and a half and doing a qualified charitable distribution? And what that means is sending money directly out of your IRA directly to the charity. And again, you have until the end of the year to do your charitable giving for tax purposes. And maybe a donor advised fund is something that you're considering funding before the end of the year. Another thing is 529 plans. A lot of our clients have kids, have grandkids, have family members, nieces and nephews, and they contribute to a tax-deductible 529. Now, some states, you don't get a tax deduction by contributing to a 529, so it will depend on your state. But that's something that a lot of people want to do. I have clients that, for example, part of the Christmas present to the grandkids is a contribution to the grandson or granddaughter's 529 every year. And another opportunity for a tax deduction would be like a traditional IRA or a SEP IRA. With a traditional IRA, you actually have until April 15th of 2025 to make that IRA contribution for the prior year. So we actually have some clients that wait until the last minute. It's not recommended or encouraged, but some people do because, they have busy lives or whatever the case may be. But that's something that, hey, maybe you can plan now for a contribution to an IRA or multiple IRAs here in a couple months. Sometimes that makes sense. And also, we like to kind of look at somebody's pay stub to see, okay, how much money are they contributing to a 401k? Is that something that we recommend that they increase those contributions to the pre-tax 401k, or maybe increasing their contributions to a Roth 401k? So looking at your pay stub towards the end of the year, you can kind of see a year-to-date total of how much you've contributed. And a lot of times, I can't tell you how many times that a client has said, gosh, that's what we contributed to the 401k. I thought we were doing more than that. So sometimes it's even setting yourself up for success for the next year. Maybe it's increasing your contributions to the HSA through work and switching gears for, let's say, somebody that's already retired. They might be able to understand that, hey, they have an opportunity here to do a $20,000 Roth conversion and stay within the same tax bracket, or they could take a distribution of that money for $20,000, pay some taxes, and maybe they had a vehicle that they were planning on purchasing in 25. Maybe they had a trip they were planning on going on. So it's sometimes making a decision, hey, what do we want to do with this money? Is it a Roth conversion with the money? Is it a distribution for a bigger purchase, a trip, or a goal that we have, or a combination of the two? And a lot of times, if you can break up these either Roth conversions or distributions into different tax years, in other words, maybe taking a distribution in December and then taking another one in January of 2025, your tax result will be beneficial. And I always ask clients, if you had a choice, you want to pay 12% taxes or 22% taxes, you pick. I've not had one yet ever say, I'm feeling a little generous. I think I'll pay that 22% tax bill instead of 12. It's never happened. And switching gears, the last thing that year-end tax planning can do is to kind of look at, okay, where do you stand for the year as far as tax-wise? Is there going to be a big liability or a big tax refund, or what's that going to look like? If there's a big tax liability that you owe, are there going to be any penalties? And if so, how do we negate those underpayment penalties altogether? The next thing that you might look at is, of course, tax withholding. So are we withholding enough on our pension income, on our IRA distributions, on our Social Security income, maybe your employment income, which you can adjust with a W-4. And it might be as simple as, okay, looking at 2025 and how your income might be different next year, and maybe we need to adjust how we're withholding for taxes. As an example, let's say you're starting your Social Security next year, and that's going to cause your adjusted gross income to increase. And therefore, we need to make some adjustments as far as what taxes we're withholding from where. So hopefully this conversation, as far as the different aspects of tax planning And more specifically, end of year tax planning will give you some ideas of maybe gaps, or maybe it's just reminders. Hey, I need to talk to my financial planner about that. I need to talk to my tax advisor about that. But these are all the conversations that really, really need to be had. And believe me, if you've got a good advisor, they're already looking out for you. But if not, hey, maybe reach out to your advisors and say, hey, what year-end tax planning should we be talking about? Hope this episode has been helpful. If you have questions, go to our website, retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. I'll see you next time. And remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The SmartVestor program is a directory of financial professionals. Neither Dave Ramsey or SmartVestor are affiliates of LPL Financial or Retire Strong Financial Advisors. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59.5 are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, many others may carry additional fees, charges, and restrictions, and the policy holder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.